Hi, in this video, I'm going to share what is capital rationing in capital budgeting. So what is capital budgeting? It is defined as the firm's formal process for the acquisition and investment of capital. It involves firm's decision to invest its current fund for addition, disposition, modification, and replacement of fixed assets. This investment in fixed assets, benefits derived in future which spreads over number of years. And what is capital budgeting? Capital budgeting. It is the planning process used to determine whether an organization's long-term investment, such as a new machinery, investment in new machinery, replacement of machinery, new plans, new products, and research development projects, are worth the funding of cash through the firm's capitalization structure. Definition of capital budgeting. It is the long-term planning for making and financing proposed capital outlays by Charles Tihon Green. Features of capital budgeting. It is potentially large anticipated benefits, a relatively high degree of risk, relatively long-term period between the initial outlay and the anticipated return, that is long-term return of benefits. They are irreversible in nature. The process of capital budgeting or decision involves which project a firm should involve, total amount of expenditure, how the funds are financed. And the stages in capital budgeting process are identification of investment proposal, screening of the proposals by various proposal, evaluating the proposal, fixing priorities, and final approval. These are the stages. After approving, implementing the proposals and follow-upping the proposals. These are the various techniques for capital budgeting. By using these techniques, we are evaluating which proposal we want to select. So the various evaluation technique for capital budgeting are, it may be classified into two, that is traditional or non-discounting method, discounted cash flow or time-adjusted method. So the discounting method, that is traditional or non-discounting method, it may be classified into two, that is payback period. It is one of the technique, and another one is accounting rate of return or average rate of return. So under discounted cash flow or time-adjusted method, the various techniques are NPV, that is net present value, IRR, that is internal rate of return, and profitability index, that is PI. These are the various evaluation technique for capital budgeting. And what is this capital rationing? So it is related to capital budgeting. That is related to investment. When there are more investment options are available, but limited resources are available, that is shortage of finance. According to this finance only, we can invest in the proposal. So we want to need to choose the best options. There are various options that are available. Helps to prioritize the options based on profitability. So the selected options which want to give a profitability and helping to select the appropriate projects. Capital rationing situation refers to the choice of investment proposal under financial constraints, because there is a limitations of available resources. So according to the resources only, the firms may select a proposal, a correct proposal which yield profit. Capital rationing is applied when a firm has a number of acceptable investment proposal, but the reserves available is restricted to certain extent. At that time only capital rationing may be applied. So capital rationing providing answer to the required fund and also the available fund. How to assign the available fund? The steps in capital rationing are, that is ranking project. We see the various evaluation technique to analyze, to select the proposal. So the ranking project means by use of any profitability measure, that is a net present value method or internal rate of return method or profitability index method. By using this evaluation technique, we will analyze the ranking project. According to that rank, we will select the proposal. Selecting projects in descending order of profitability until the budget exhausted. The various advantages of capital rationing are: budget, surely. According to the limited resources, the fund available, the budget may be planned. So there is no chance for wastage. So no wastage and fewer projects. We can earn higher returns and it is more stability. So budget, it introduces a sense of strict budgeting of corporate resources. No wastage. It prevents a wastage of resources by not investing in every new project available for investment. According to that evaluation technique, we will select a correct project and we make investment on that particular project. So there is no wastage. And fewer projects means it ensure that less number of projects are selected by. There are various proposals, so we are selecting our best options only. So fewer projects. And higher returns. Invest only in project where the expected return is high, thus eliminating project with lower returns in capital. And it is more stability. Since the company is selecting those projects where the expected return is high, thus ensure stability for those times as well. These are the various advantages. Investment decision and risk analysis. So, what is risk? Risk involves the chance an investment's actual return will differ from the expected return. Risk includes the possibility of losing some or all of the original investment. So there is a chance. So definition of risk according to Emmett J. Wagen, risk is a condition in which there is a possibility of an adverse deviation from desired outcome that is expected or hoped so far. Uncertainty. So what is the meaning of uncertainty? The lack of certainty, a state of limited knowledge, where it is impossible to exactly describe the existing state, a future outcome, or more than one possible outcome. Risk analysis is the systematic study of uncertainty and risk we encounter in business, engineering, public policy, and many other areas. So, difference between a risk and uncertainty. Basis for comparisons on the basis of meaning, ascertainment, outcome, control, minimization, and probabilities. On the basis of meaning, a risk means the probability of winning or losing something worthy is known as risk, but uncertainty implies a situation where the future events are not known. And in ascertainment, it can be measured, but in uncertainty, we cannot be measured. In outcome, chances of outcomes are known, but in uncertainty, the outcome is unknown. It is controllable and it is in uncertainty, it is uncontrollable. So minimization of risk, yeah, it is, yes, we can minimize, but uncertainty, we don't know when it happens. So we can't minimize it. So there is no probability means risk is assigned, but uncertainty is unknown. So it is not assigned. So these are the difference between risk and uncertainty. Techniques of measuring risk are sensitive technique. It is one of the technique. Sensitive analysis is a good technique for forecasting the attention of management on critical variable and showing where additional analysis may be beneficial before finally accepting a project. The conditions are optimistic, most likely, and pessimistic. These are the conditions. Sensitivity analysis involves the following 3 steps. Step 1, identifications of those variables having influence on the project. So that is NPV, net present value, and or IRR, that is the internal rate of return. A definition of the underlying quantitative relationship among the variables. And step 3 is analysis of the impact of changes in each of the variables on the net present value of the project. And the advantages of sensitive analysis are it gives greater visibility to the weak spots in an investment. It will help to more critically investigate such factors to validate the assumption. It aids management in proper decision making. These are the various advantages, and the limitations of sensitive analysis are variables are often interdependent, which makes examining them each individually unrealistic. For example, change in selling price will affect the change in sales volume. The analysis is based on using past data or experience, which may not hold in future. Assigning a maximum and minimum or optimistic and pessimistic value is open to subjective interpretation and risk preference of the decision maker. It is neither risk measuring nor a risk reducing technique. It does not produce any clearer decision rule. Scenario analysis. In sensitive analysis, typically one variable is varied at a time, but in scenario analysis, several variables are varied simultaneously. That is simultaneously. Most commonly, 3 scenarios are considered: expected scenario, pessimistic scenario, and optimistic scenario. In the normal scenario, all variables assume they're expected. In the pessimistic scenario, all variables assume their pessimistic values, and in the optimistic scenario, all variables assume their optimistic values. Thank you.